Ladies and gentlemen, please give a warm welcome to our first speaker of the day, Director at McKinsey & Company, Kausik Rajgopal.
It's a privilege to be here. I am going to attempt to do the impossible, which is to boil down the extraordinary range of innovation that's happening in payments within fintech in 10 minutes to 10 trends. 10 years ago, John Shepard Barron, who invented the ATM, predicted the end of cash within a decade. And while we're still waiting for it, it's unquestionably true that payments innovation and fintech innovation are at an all-time high. And we capture the spirit of this in the report we released today at the conference, Payments on the Crest of the Fintech Wave. Our global panorama database captures and tracks fintech experiments, essentially startups globally. Today, we count more than 2,000 fintech startups around the world. And payments represents a significant chunk of this. As you'll see here, retail banking and payments intersect for a significant component of fintech innovations around the world. Payments is actually only about 20% of retail banking economics, but we believe that the reason it is such a focus for innovators is that it represents a significant point of entry into the customer relationship. And while there's other growth in startups in the lending space in particular, we believe that payments will continue to be a significant portion of fintech innovation. About 900 of those 2,000 plus fintech startups are payments players, and in the last 5 years, payment fintech players have received more than $7 billion in funding around the world. Many of these will fail. In fact, if we go back to the era that we call Fintech 1.0, the 7-year period that begins with the IPO of Netscape in '95 and ends with the acquisition of PayPal by eBay in 2002, there were more than 450 fintech startups. About 1% of them survive today as standalone businesses. But many of these created hugely interesting and innovative capabilities that were acquired by others. So while we expect a high failure rate, we also believe that there are pockets where fintech experiments will succeed with greater speed and alacrity. China is a great example of such a market. Here we profile the Ali ecosystem, which begins with e-commerce, but is now extended well into financial services with a large number of accounts, credit for small businesses, and credit scores for consumers, among other things. The failures will be driven, we believe, overwhelmingly by 3 factors: risk and regulation considerations, credit and business cycles, and perhaps the most important threshold factor, the cost of customer acquisition. Here we look at the cost of customer acquisition for traditional banks versus, on the right-hand side, a large e-commerce ecosystem like Ali. And you see the ecosystem plays that have worked well in the past. Think about all the ways in which eBay helped subsidize PayPal's cost of customer acquisition nearly 20 years ago, and the way in which Shopify helps Stripe today. We believe that a critical marker of fintech success is to look for advantaged ways in which customers are acquired. And if you're not part of a large ecosystem, partnerships with large ecosystems are a critical way of getting there. Around the world, the other exciting thing that's going on in payments is the upgrading of infrastructure. There are several central banks around the world now stewarding initiatives around faster payments. The US Federal Reserve is one of them. And the potential for faster payments is quite exciting. It may be stunning to share this, but this year the United States will write 17 billion checks. That is more checks than the next 55 countries combined. So if we step back and think about the potential for faster payments, to create a rail or use existing rails, to do everything from peer-to-peer payments, urgent payments, government and insurance payouts on an expedited basis, we believe the potential is quite significant. And the key success factors here will not be around the infrastructure. It will be around putting the customer first and designing compelling propositions for use cases that really matter to customers. Cross-border payments remains a growth hotspot. We talked about this a couple of years ago at Money 2020, and it was a big theme in this year's conference as well. We estimate that on a blended basis, cross-border payments are growing 4 to 5 times at the rate of domestic payments, with 2 to 3 times the margins. The single biggest retail category that shows the highest growth in payments today is Chinese consumers buying baby products overseas. Because as they become more affluent, they are looking for the best brands around the world and are transacting increasingly online and mobile to acquire them. At the same time, we believe a different part of cross-border, which is cross-border money transfer, is harder to disrupt. And the reason for this is that the anti-money laundering and regulatory compliance considerations in money transfer, we believe, add to the complexity of the business and create a moat for incumbents. And at the same time, the corridor complexity means that you actually have to build a corridor one at a time. Just because you have solved the corridor that is US to India doesn't mean that you can very easily then go and solve UK to Nigeria. So cross-border money transfer, in distinction with cross-border payments, will be a tougher putt for innovators. In merchant acquiring, we see a few things happening that really rise the level of competitive intensity. The first is the ongoing pressure and commoditization of raw processing economics. So here you see, and we've highlighted in particular for small merchants, what we estimate merchant acquiring margins to be, and they're continuing to decrease. And small merchants account for the vast majority of merchant acquiring economics. At the same time, you see the rise of closed-loop propositions, such as Chase Pay, and the extension of mega ERP players like Oracle and SAP through acquisitions into more cloud-based platforms. And in the SME segment, we see an ongoing transformation to digitize the point of sale and put the point of sale in the cloud. All of these converge to create critical choices for merchant acquirers to consolidate, compete, or partner, and find efficiencies while doing so. On the issuing side, we believe that it is critically important for payments players to meet the technology standards of customer experience and marketing velocity. So look, for example, here at eBay, which runs hundreds of marketing pilots every year to pinpoint the most effective strategies to engage customers. In contrast, an average card issuer is probably running 1 or 2 tests a month. A big part of this has nothing to do with marketing or technology. It has to do with making the control functions, like risk, legal, and compliance, more agile. And we're seeing some very interesting innovations from card issuers around the world in not just making IT and technology more agile, but in making the entire business more agile. And that means bringing together functions to co-locate, work together, and accelerate the velocity with which you reach out and engage customers. In an age where you can call a car just by clicking a button, we believe this is critically important for payments players to be top of wallet with their customers. And the top of wallet dynamic is accelerating. So today, we estimate that 70% of digital shoppers will not change their primary card in digital wallets. And they only load 1.6 out of the average 3.7, this is a US number, that they own in the digital wallet. So if you are an issuer or you are a network, this is a battle for relevance. And the overarching message here is that the customer is increasingly in control. As a payments player, you need to increasingly make the investments to engage the customer. This goes to why we believe while the failure rate in fintech and payments will still remain high, more than 9 out of 10 will fail, those that succeed will break through and build more interesting, compelling, and scalable businesses than in the fintech 1.0 era. Just as an example, I was talking to a fintech entrepreneur who had a startup that failed in '99 and has a more successful endeavor now. And I asked him, what is the big thing that's different besides the obvious things that people talk about, like mobile devices? And he said, you know, in '99, with no customers and no money, I had to buy servers. And today, I can scale a business on the public cloud. And that lowers the barriers to entry, creating much greater opportunities and experiments for potential innovation. And finally, 2 years ago at Money 2020, we made the observation that the new news and the real news in Bitcoin was not about the coin, it was about the bit. In other words, it was about the underlying technology and what it could enable on cost reduction and risk management. And indeed, now we are seeing a rising number of experiments with the blockchain to assess its potential and meet challenges. We believe that this will, over time, be an evolution and not a revolution. So in the near term, we don't expect some massive shift to the blockchain, but we believe a lot of these experiments will continue and, over time, help increase the efficiency of infrastructure, whether it's for cross-border payments, or for clearing and settlement, or for trade finance, or for syndicated loans. Thank you for having me. I hope this has been a quick, rapid-fire tour on what we see happening broadly in payments and fintech. We believe it's an extraordinarily interesting time with the lowering of the barriers to entry, the rise in computing power, the ubiquity of mobile devices, and perhaps the most exciting thing, that customers are in control. The winners, whether they be incumbents or newer players, will be the ones that design the most compelling front-end customer experiences and deliver them with the greatest efficiency. Thank you.